What's up everyone, it's Karthik with MoneyVest. I've got a big update for all of you because I've been spending the last couple hours compiling all the data for all of you guys for the month of September, because September is now finally here. So we're going to be taking a look at the September seasonality and also talk a little bit about specific weeks of September where we tend to see the most drawdowns for the market. So hope you all enjoy this video. We've got a lot of spreadsheets to go over. Make sure that you drop a like. I also want to remind everyone that today is August 31st. So today is quite literally the last day if you want to take advantage of the Patreon discount of 16% annual discount. And there's 4 more spots left. It was sold out up until a few hours ago. I've opened up a few more spots if you want to take advantage of that discount. That will go away after midnight tonight. So link's going to be down below. And again, we'd love to have you on board. If you have any questions, please feel free to also let me know. There's one more thing that I want to mention, and that is I'm almost done transporting all the courses from Teachable over to Patreon. So for anybody who wants to access these courses in a nice subscription fashion, we'll be able to do that in the next few days. I will make that announcement and it's going to be available as well. Okay, so let's just get started here. And first things first, let me just bring over a few spreadsheets and we should be all set. Boom, let's go. Okay, first things first. In the last day, we have seen a lot of influx over in large cap growth. So again, lots of outperformance for large cap growth here relative to some of the other parts of the market. However, other parts of the market are still somewhat leading since July 10th. And as much as technology has recovered, other parts of the market, in other words, some staples, utilities, energy, and financials, those are the 4 sectors that still are seeing more and more momentum into those parts of the market. This right here is how the markets did, of course, on Friday. And August was a flat, a little bit slightly higher month for NASDAQ. S&P 500 was higher in the month of August, and the Dow Jones is almost trading back up to all-time highs, up over 228 points on Friday. S&P was up 1%, and the NASDAQ up over 1.1% as well. Now, according to Morningstar, we are seeing large cap growth here, so which is 70% of the capitalization of the U.S. equity markets are typically projected to grow faster than the other large cap stocks here, and they are considered right now overvalued by 5.2%. This is their valuation as of August 29th, 2024. This is US market fair value. Again, also suggesting for an overvaluation of about 5.2% for the US equities. And you'll notice that, of course, we were undervalued for majority of times in 2022, as we were seeing that significant bear market of 2022. We sold off quite aggressively. A couple more dips here and there where we have seen the markets, according to Morningstar, a little bit more on the undervalued side. And then, of course, a lot of peaks here, 20% to as much as 25 to 30% overvalued in the past. And now we're a little bit more modest at 5.2%. Fear Greed Index for CNN is back over 60. So we are now in the greed zone for the CNN Fear and Greed Index. And this right here is going to be the personal income and outlays and the PCE numbers, which came in on Friday. Core PCE, which is the Fed's preferred measure of inflation, coming in at 2.6%, a little bit lower than what the consensus expectations were of 2.7%, and month over month increasing by 0.2%, slightly in line with the consensus expectations. And then finally, if you come over to personal income, also growing by 0.3%, and PCE price index month over month 0.2%, year over year sitting at 2.5%. So slowly and steadily kind of moving down to the Fed's target. Okay. Let's come over to the spreadsheet that I've been working on. I'll go over that. So these are the spreadsheets that I really want to go over. And what I did here is essentially going back as far as 1989, or actually 1979. So we're going back a little bit over 45 years to go back to as much as 1979 to figure out what is the weekly return for the S&P 500 for every single week, right? So we're looking at week 1, 2, 3, 4, 5. And what this is essentially doing is it's going into the week 1 is essentially the first close in September, right? This could be September 2nd, 3rd, 4th, 5th, 6th, right? From August, from the last week of August close to the first week of September close. That is week 1 that I'm accounting for. Same as September, September's week 2, 3, and 4, and then 5th is going to be rippling into a little bit into October as well. So I think it's really important for us to remember that week 1 through 5 is not exactly all the trading days in September, but a little bit of August and a little bit of October, because that's really what's going to give us the more precise understanding of where we closed in August and how the markets performed from the end of August to the beginning of September, and then how the markets were coming out of this at the end of September towards the beginning of October. So this is essentially encompassing all of these September trading days. So since 1979, and the findings are actually quite interesting, what you'll notice is that week 1 tends to be pretty flat for the market. We don't really see a lot of momentum to the downside for week 1. Week 2 also average about 0.07, median 0.53%. So it's not until week 3 and 4, basically the last weeks of September, is when the selling pressure accelerates. So we're talking post September 15th is when that selling pressure accelerates. We're looking at average 0.63%, median negative 0.28%, and the last week at negative 0.23% and negative 0.44%. And then going into October, we start to recover a little bit back higher. So week 3 and week 4 are negative on both average and median basis, and the probability is also well over 50%. So 57% for week 4 that the markets are going to be red in September. And September week 4 tends to actually be very, very brutal. As you can see that 2022, 2021, 2020, and 2019. So we basically saw all 4 years, last 4 years, we had September red, as you can see over on this chart. So this is September 2023, 2022, 2021, and 2020. All 4 years we were negative in the month of September. And the selling pressure essentially accelerated in week 3 and week 4. So this right here is 2023, 2024. So let me just highlight that very quickly. That's going to be the reds over here. Week 4 for 2024 over here. And then 2020 was both. This right here was the first 3 weeks we were actually red for 2020. And again, 2022 we essentially had week 2, 3, and 4 also red. So 2022, of course, being very brutal. All 3 weeks were selling off quite aggressively. This is week over week change, by the way. And this right here is going to be the 2023 sell-off. But all in all, we had 57% probability going back as far as 45 years. The markets are red in week 4, 53% in week 3, and that's where the selling pressure accelerates. You can actually see that in the chart over here. This right here is a good representation of S&P 500's seasonality since 1950s. So a very, very similar chart to what I essentially showed you guys. And if you come over here, September 2019, September. So 19, 18, 17, 16, 15. So this right here is really the time frame that I really want you to focus on, because up until this time frame, we are basically flat, right? So S&P is kind of like in this range, and it's not until the last couple weeks of September when the markets really starts to draw down because of that September seasonality playing a role. This right here is also a very interesting data point suggesting for S&P 500's performance in election years with or without a recession. So this is a point in time when there were elections since 1928, when the S&P 500 obviously went higher, as you can see, when we did not experience a recession. This is after August, going into September, October, November, and this was as of August 27th, and then all the other years. All the other years, we do tend to see September seasonality once again kicking in a little bit. We see that pullback, October forming a bit of a low, and then the market's exploding in the fourth quarter. But when we don't see a recession and there is an election year, we tend to see that performance continue throughout. Doesn't matter whether it's September or October, doesn't matter the month of the year, we continue to push higher. So election has very little to no impact on the markets because they tend to actually perform much better regardless. Now, this right here is Bank of America's implied dollar forecast. So they are expecting the dollar index to continue to come down. They're expecting at just a little bit under 100 by July 2025. And the reason why this is so important is because, we've discussed this in our previous videos. Like, we've talked about how there is a significant inverse correlation between the dollar and the S&P 500. Every time the dollar tops, the S&P 500 bottoms. And then, of course, every time the dollar tops here, you can see the S&P 500 essentially bottoms. So we are, again, moving in the opposite direction. Actually, the black line is the S&P 500. So you'll notice that, again, S&P 500 over here at a very high level, the dollar index is lower. And then since the dollar index is once again back down, if it starts to rotate back higher, then of course that could lead to the S&P 500 also coming down again because of that inverse correlation that we have talked about in our previous video. So US dollar weakness, equity market strength, US dollar strength equals equity market weakness. So that is the inverse correlation. In the past 6 weeks though, dollar index weakness as equities sold off, and then afterwards as they rallied as well. So they've recovered, but the dollar index continues to move downwards. A lot of that also had to do with the carry trade over in Japan, but that inverse correlation is still present and still valid. So if the dollar index starts to recover just a little bit, that can put some pressure on equities moving forward. This right here is, of course, S&P 500's return, 12-month performance return after the first rate cut. We've already discussed this and actually did a full-blown video and detailed analysis on this as well. And I think it's really important to understand that, the only 2 times we've actually seen the markets come down and sell off 12 months later was in 2001 and 2007. Because of the dot-com bubble bursting and, of course, the great financial crisis as well. Every other time the markets are higher 12 months later after the Federal Reserve has done quantitative easing, or essentially they have started cutting interest rates. Now this right here, NVIDIA will grow to a $10 trillion company, and the Blackwell chip will be like fireworks for the stock. So again, authorizing a little bit of those $50 billion buybacks. Everyone seems to be still very optimistic on NVIDIA. So that is a good thing. And I've again traded NVIDIA in the past, and I've actually started a new position in NVIDIA as well. We'll continue to trade options on NVIDIA because the premiums are so juicy, they're so good, and we'll continue to generate some nice little income from NVIDIA stock. So stay tuned, join our Discord, join our Patreon if you want to get access to those options alerts every single week. But this right here is also very interesting data, which is essentially S&P 500 performance with respect to NVIDIA's earnings reports, and it's only really followed 3 of the 7 times, which is going to be once over here, second time over here, and the third time was over here, meaning that the market and the S&P 500 were both moving in the same direction. However, this time around, even though NVIDIA had a little bit of a negative reaction to the earnings, S&P 500 still performed really well and pushed higher. And this right here, again, are the times when they didn't quite move in the same direction, or the correlation was actually not indicative of, basically the correlation was not existent. That's the one way to put it for this chart. Now, when it comes to Russell 2000, I actually have a position on Russell 2000, so I wanted to show you guys. So this right here is my current position in IWM, just up a little bit over 7%, so just over $2,100, and we'll continue to buy and dollar cost average into this position because I do believe it has a ton of potential, as Tom Lee's very bullish on Russell 2000, and as interest rates continue to come down, it's actually small caps that tends to perform much better compared to large cap and mid cap counterparts. And this right here is the all-time drawdown and also the consecutive days since new all-time highs, and right now we're still nowhere near close to all-time highs, but we're starting to rotate back higher a little bit. So this chart, of course, has been pushing higher because we are now no longer down 33%, but I think down less than 10% from its all-time highs. And it's been well over 700 days for Russell 2000 to see a new all-time high. The maximum we've gone is 959 days back in 2010, and prior to that was over 845 days post 2002. So it's been quite a few times where the Russell 2000 does not trade back up to all-time highs, but eventually it does, because again, these companies are the mid-cap, small-cap companies that are consistently growing. There's productivity, there's spending, and they are doing incredibly well. Especially there's going to be a much favorable environment once interest rates start to come down, where September probability again is for rate cuts to begin. So this is also going to be one of those trades. And then finally, S&P 500's blended earnings in the second quarter 2024 at 5.4% revenue growth. We're looking at 12.5% earnings growth and 12.2% net margins, with of course the majority of those margins coming from technology at 25% and a growth of almost 20%. That's the most growth for any company, along with financials and healthcare growing also at over 20%. And we got consumer discretionaries 14%, utilities at over 15% also. And then we got comm services 7.4%, just under 15% margins, 18% margins for financials as well. So very, very strong growth. And if you exclude for energy, we're looking at 13.3% growth rate for the earnings for S&P 500. And then finally, real GDP growth has clocked a 2.8% annualized since the Federal Reserve amped up tightening 2 years ago, thanks to services, spending, and government. GDP growing at very, very solid pace at 2.8%. Those were the numbers that also came out last week, suggesting for the economy continues to be very, very strong. Jobless claims are low. Unemployment rate is low. However, it is accelerating higher. So next week, we're going to get those unemployment numbers for us to evaluate and analyze and see what the situation is with respect to the jobs market over in the US. A few more things I want to discuss is the September seasonality in a little bit more detail with regards to the volatility, because as we know that as September is one of those months where Seasonality takes into account week 3 and week 4, so towards the end of September is when markets start to really sell off. Volatility also on average has been at just under 25. That's over the last 13 years in the month of September, so that does suggest a 70% spike in volatility. And if you actually come over to VIX Central, it's going to give you a little bit of an idea of the next few months of contracts. And you'll notice that this right here is still in backwardation, right? So we're in contango for the first front 2 contracts, but if you go over to month 2 and month 3, so meaning M2 and M3, we are in backwardation once again with negative 1.55%, suggesting for, again, that's the October contract, which is priced a little bit higher compared to the November contract. And again, October contract is priced higher than September. Right now we're at 15.4, but 17.3, 17.4 is what the markets are expecting right now from volatility. Which again, if it does end up spiking, is going to lead to a market also rolling over because of that negative correlation between the volatility and the S&P 500 as what we have witnessed. So if we do get up to, let's say 17, 18, that's still a 20-25% spike in the VIX. And of course, historically speaking, September is one of those months where VIX is much higher at well over levels closer to let me just come back, and this is right here, so 24.25, which again is going to represent well over 70 to 80% rip in the volatility. So let's see what this September looks like for the market. Let me know your thoughts down in the comment section below. Are you expecting September seasonality to once again play a big role in the markets and sell off, or for the markets to just shrug off this September and continue to rip higher in anticipation of this rate cut and not having a potential recession, and again, anticipation of this soft landing as well? For me personally, the way I'm kind of positioned going into September is going to continue with that options portfolio and strategy of selling puts. If the markets come down, that's even better because premiums are going to be much higher, and I can generate a higher yield on collateral. So that's going to continue, and then I will continue to dollar cost average into my ETFs and individual stocks, and while also raising some more cash and getting some cash together for a potential pullback or a correction. A couple more things I want to show you is that the MoneyVest index is now well over 4. So if you come over to our MoneyVest index, we are now sitting at over 4.05, which is again a pretty high number. We were, just a little bit over 4 a couple of days ago. Then we came down to 3.95, 3.98, and we're back over 4. And if you come over to this, we are now at over 91% of stocks that are now trading above their 20 simple moving average, with just a little bit over 81% stocks trading back above their 50 simple moving average, and 78% of stocks trading above their 200 simple moving average. So this right here, again, showing us a lot of technical overbought conditions. MoneyVest index back over 4. Volatility is really low. Morningstar's market valuation suggesting for 5.2% overvaluation. And then also CNN greed index suggesting for a little bit of greed back in the market right now. So you got to be super careful and cautious here. I know nobody wants to be objective. Everybody wants to have fun. And while the markets are going up, everybody wants to just keep seeing more and more green and gains. But I think it's really important for us to remain calm, be objective, be cautious, be alert, and again, trade the markets that we are currently in, not the markets that we hope to be in. So don't predict, simply plan and take your trades and investing decisions based on proper planning and due diligence. As always, make sure you drop a like, subscribe to the channel. Again, links to our Discord and Patreon is going to be down below. There is a 16% annual discount that does expire at midnight tonight. Happy investing. I'll see you all in the next video.